If you've ever looked at a deal and thought, this should get funded, but it doesn't, you're not alone. In fact, most deals that fail don't collapse because of the market, and they don't fail because there isn't money available. They fail because the capital sequence is wrong. That's the reality no one talks about. Today, I want to walk you through how to structure a 7-figure funding sequence step by step, the way capital markets actually think, not the way most sponsors assume it works. Because once you understand sequencing, not just how much money you need, but when and how each layer of capital comes into play, you stop guessing, and you start structuring deals that can actually close. The first thing you need to understand is that capital does not fund ideas. It funds users. Most people approach financing by saying, I need 5 million, or, I need 10 million, but they can't clearly articulate what each dollar is actually doing. That's where the problem starts. Capital providers don't look at your total number first, they break it down. They want to know exactly where the money is going, what risk is attached to each portion, and how that risk evolves over time. Acquisition capital is not the same as construction capital. Working capital is not the same as stabilization capital. Each one carries a different risk profile, and each one belongs to a different type of capital. If you present everything as one blended request, you're effectively telling the market that you don't understand your own structure. And when that happens, the market disengages very quickly. Once you've clarified your uses of funds, the next step is understanding the phases of your deal. This is where most sponsors make a critical mistake. They try to raise all the capital up front without recognizing that different stages of a project carry fundamentally different risks. Early stage capital is always the hardest and most expensive because nothing has been proven yet. There is no traction, no validation, and no margin for error. As your deal progresses and certain risks are removed, capital becomes cheaper and more accessible. But if you try to raise late-stage capital at an early-stage position, the market will reject you every time. That's why sequencing is essential. You need to break your funding into phases that align with how risk actually unfolds. Each phase should stand on its own, with a clear purpose, a clear outcome, and a clear justification for the capital required at that stage. From there, you need to match the right type of capital to each phase. This is where deals either start to come together or fall apart completely. Not all capital behaves the same way, and not all capital is appropriate for every stage of a deal. Senior debt wants stability, predictability, and security. It is not designed to take early-stage risk. Mezzanine or structured debt can tolerate more uncertainty, but it comes at a higher cost and often with tighter controls. Equity is looking for upside, but it also expects alignment, influence, and a clear path to liquidity. Private credit can move quickly, but it prices risk aggressively and expects strong collateral or structure in return. If you mismatch the capital type to the phase, the deal will not work, no matter how compelling your story is. The market doesn't adjust to your narrative. Your structure has to align with the market. Once you've aligned your phases and your capital types, the next step is building your capital stack. This is where a 7-figure deal becomes real. Most deals at this level are not funded by a single source. They are layered. You might have senior debt covering a significant portion of the total requirement, with subordinated debt or mezzanine capital filling part of the gap, and equity bridging the remainder. But here's what most people miss: the stack is not just about filling percentages. It's about alignment. Every layer in the stack needs to understand its position, its risk, and its return, and more importantly, each layer needs to be acceptable to the others. Lenders don't just underwrite you. They underwrite the entire structure. If the equity is weak, the senior lender pulls back. If the senior lender is too aggressive, the mezzanine provider steps away. If there's confusion about control, nobody moves forward. A well-structured capital stack is one where every participant is comfortable not just with the deal, but with each other. As your structure starts to take shape, credibility becomes the next defining factor. This is where deals either gain traction or quietly disappear. Real credibility doesn't come from enthusiasm or storytelling. It comes from clarity, discipline, and control. Capital providers want to see that you understand your deal better than anyone else in the room. They want to see that you thought through the risks, the contingencies, and the execution strategy. They're not investing in your optimism. They're protecting against your downside. So you need to demonstrate that your structure holds even when things don't go perfectly. That's what builds confidence. And confidence is what brings capital into the conversation. Timing is another factor that can make or break your funding sequence. Going to market too early is one of the most common and most damaging mistakes sponsors make. Once your deal is seen and rejected, that history follows you. Capital markets have memory, and it's not forgiving. If your deal circulates before it's ready, before the structure is clear, before the documentation is complete, before the narrative is aligned, you lose your opportunity to make a strong first impression. That's why discipline matters. You have to be honest about whether your deal is truly ready for capital. Not in your own opinion, but in the eyes of the market. If you're still figuring things out, you're not ready. And going to market at that stage will do more harm than good. When your deal is ready, packaging becomes critical. This is where your structure is translated into something the market can actually evaluate. A lender-ready package is not just a collection of documents. It's a coherent, consistent presentation of the opportunity. This is where a proper confidential information memorandum comes into play. It needs to clearly articulate the deal, the structure, the risks, and the mitigants in a way that aligns with how capital providers think. There can be no contradictions, no gaps, and no ambiguity. Every detail matters, because every inconsistency creates doubt, and doubt is one of the fastest ways to lose momentum in a funding process. Once you go to market, the focus shifts to execution. This is where many deals start to lose control. Sponsors begin reacting instead of leading. They allow multiple interpretations of the deal to emerge. They respond inconsistently to questions. They change terms mid-process. And what happens is predictable: confidence starts to erode. You need to control the narrative from start to finish. Every communication must reinforce the structure. Every response must be aligned. Every interaction must build momentum. Because deals don't close on numbers alone. They close on conviction. And conviction comes from consistency. At the same time, you need to manage expectations. Seven-figure financing is not cheap, it's not instant, and it's not always flexible. Rates may be higher than you anticipated. Fees may be more substantial than you expected. Terms may be tighter than you would prefer. But that's not the issue. The real question is whether the structure works within those parameters. A deal that closes on realistic terms is far more valuable than one that never closes because it was chasing ideal conditions that don't exist in the market. Understanding that difference is what separates experienced sponsors from those who struggle to get deals across the line. And finally, everything comes down to execution discipline. This is where deals are either completed or abandoned. Getting a term sheet is not the finish line. It's the beginning of the most critical phase of the process. You need to stay engaged, responsive, and focused. Conditions need to be met. Issues need to be resolved quickly. Communication needs to remain clear and consistent. Deals don't fail at the beginning. They fail in the middle, when fatigue sets in and attention starts to drift. That's where discipline matters most. When you put all of this together, a properly structured seven-figure funding sequence becomes clear. It starts with precise use of funds clarity. It evolves through phased capital aligned with real risk. It incorporates the right capital types in the right positions. It builds a coherent and aligned capital stack. It establishes credibility and control. It enters the market at the right time. It is packaged professionally. It is executed with discipline. And above all, It is built on readiness. Because capital does not reward effort. It rewards preparedness. And that's the distinction most people miss. If you're watching this and realizing that your deal may not be structured the way the market expects, that's not a problem, it's an opportunity. Because once you understand how to structure capital properly, you stop chasing funding, and you start attracting it. If you want to see how your deal stands from a real capital markets perspective, not in theory, but in practice, that's exactly what we do. We don't just connect you with capital. We structure your deal so that capital can actually engage. Visit our website or reach out directly to take the first step toward building a funding sequence that works in the real world, not just on paper. Because at the end of the day, the difference between a deal that closes and one that doesn't is almost always structure.